He is the co-founder of Retail E-Commerce Ventures, which has been buying distressed, well-known brick-and-mortar brands to turn them into hopefully successful e-retail businesses.
On October 30th, I purchased Dress Barn, a company with $740 million revenue in the last 12 months. I'm taking it online, closing down 650 department stores, improving the economics on this business. And this is just the beginning.
If you ask Ty, he'll try to sell you the dream that this approach to buying and restructuring failed businesses is completely unique, has a low risk profile, high returns, and no one has ever thought about this before. But the reality is this investment strategy is none of those things. He has a long history of blurring the ethical lines and engaging in shady, deceptive business practices, if not outright fraud. He's definitely an experienced businessman, but from what I've seen, he seems to operate with a very Machiavellian mindset, meaning he'll do whatever benefits him. So if running a business ethically benefits him, he'll do it. But if it doesn't benefit him, he won't. Operating on pure self-interest rather than moral principles. Okay, so here we have a New York Post article saying that the owner of Radio Shack, Pier 1, and Modell's in danger of bankruptcy filing. And that's obviously Retail E-Commerce Ventures. Okay, the flashy firm that has scooped up a slew of bankrupt retail brands, including Radio Shack, Pier 1 Imports, and Modell's Sporting Goods, is now in danger of filing for bankruptcy itself, the Post has learned. Miami-based Retail E-Commerce Ventures, whose CEO Ty Lopez is a self-help guru who lists Bill Gates and Mahatma Gandhi as inspirations and charges $1 million a year for coaching and consulting expertise, has spent $120 million to amass a portfolio of aging retail names that also include Dress Barn, Linens and Things, Steinmart, and the Franklin Mint, according to a source with knowledge on the firm's finances. But lately, Lopez and his co-founder Alex Mir, a former NASA blah blah blah, are opening the books of their privately owned licensing company to prospective investors for a potential sale of all their assets, a bankruptcy filing, or Hail Mary financing, the source said. Okay, so basically they just want to sell everything they have for likely pennies on the dollar, declare bankruptcy, or get some last minute financing to stay alive for God knows how much longer. And we're going to see why that is. And they got this picture of Ty, not very flattering. They kind of did him dirty here. All right. Retail E-Commerce Venture CEO Ty Lopez is a self-help guru. I already said that. They are burning through cash, said one source with direct knowledge of the situation. All right, let's look at the numbers. REV's revenue and losses last year are both about $60 million. Okay, so meaning that they did $60 million in sales in 2022. So we're going to keep track of this. And $60 million in losses. Okay, in 2022, compared with $150 million in sales in 2021, and about $90 million in losses, according to the source. So if we track that, that's horrible. First of all, between 2021 and 2022, sales went down, about 60%, from 150 to 60. And then losses went down, about 33%, from 90 to 60. So even though losses went down, the sales to loss ratio went up. It went from, a 5 to 3, 150 to 90, down to a 60 million to 60 million. So they're losing more per dollar of sales, which is horrific given the investment model that Retail E-Commerce Ventures is employing. And we're going to get to that later, why having these kind of losses is so devastating for what they're trying to accomplish in this fund. It has racked up about $200 million in debt, the source added. How is that even possible? They spent, they spent $120 million and they somehow racked up $2 million in debt? Jesus Christ. Mir and Lopez did not respond to multiple emails and calls for comment. What a surprise. On Thursday, the Wall Street Journal reported that REV has hired law firm Kirkland and Ellis to explore restructuring options. Whew. I would say with those kind of losses. The company recently said that it will pause payments on its debts. What a nice way to say we're not paying anybody. The Journal reported citing a lawsuit filed by the vendor this week. A major red flag surfaced last month when discount retailer Tuesday Morning filed for Chapter 11 just months after Mir and Lopez paid $35 million for a controlling stake in the Dallas-based chain last September. So they bought a controlling stake in this dying company for $35 million, and then a few months later they filed for Chapter 11. The incompetence. This is clown business. The realization that an investment they made less than a year ago is not worth what they put into it could have implications for them because they have investors, says Adam Stein-Sapir, portfolio manager of Pioneer Funding Group, which focuses on distressed debt. It makes it more difficult for REV to raise funding with investors who might be thinking, you guys just lit millions of dollars on fire. Yeah, you think? All right, more photos of these clowns. Co-founder Alex Mir, blah, blah, blah. Lopez, who boasts 80 bit, blah, blah, blah. Charlie Monkey, who cares? Lopez teamed up. There's a lot of repeating themselves. Okay, Lopez teamed up with Mir at the height of the retail carnage in 2019 when nearly 10,000 stores went out of business. REV snapped up the rights to the chain's intellectual property, shedding the brick and mortar locations with a plan to run them as an online-only business. They shelled out $20 million for Pier 1 imports, $3.6 million for Modell's, and $6 million for Steinmart. Now, this investment strategy isn't necessarily a horrible idea if done correctly. Obviously, they're not doing it correctly. But if done right, it could make sense to buy Pier 1 for $20 million as a declining, dying company, or $3.6 million for Modell's. So the way that this investment strategy actually can work and be fairly lucrative for investors is, the best way to think about it is if you look at the life cycle of a business. So we put the graphic up here. In the beginning, you first, you make your product and service, you find the product market fit, you start making sales. That's the startup phase. And you start, as soon as you get that product or service going, you get it to market, you start marketing it, you grow it as fast as you can, the growth phase. And at that point in time, you shouldn't, assuming the internal economics work, you shouldn't be focused too much on, am I making money? Am I losing money? You should be focused more on getting your sales, getting market share, or if it's a new market, growing as fast as possible to get ahead of competition or future inevitable competition. Then you could have losses in that phase of the business, because in that phase, all you really care about is getting as many customers and as much market share as possible. You don't really care about are you turning a profit and making cash on cash returns. Okay, and this is usually you're going to need to raise capital in this phase of the business life cycle. But then once you get more mature and your growth slows down, it's called the slowdown stage of the business life cycle. Let's say 10-20% yearly growth. Once you start slowing down, that's when you need to start focusing more on profitability. Like, I guess a recent example would be a lot of these tech companies, Meta, whose sales decline. I think last year was the first time in a while that their sales declined. So now they're focusing on cost cutting. They laid off a quarter of their staff so far. Probably more layoffs coming. If you find a way to cut costs as revenue's declining so you can maintain profitability, that difference, that declining revenue but also bare bones cost, allows you to maintain a profit margin as it declines. And all you have to do is, let's say you determine, all right, this once great company I'm going to buy for $5 million as it's declining, as it's dying. But as I buy this company for $5 million over the next, let's say, 10 years, I'm able to squeeze $15 million in profit out of it. Okay. As it declines. And then after about, 10 years, the company declines to a point where you can no longer operate it profitably. So you put in $5 million over the course of the next 10 years, you triple that. You get $15 million in cash on cash returns. You give that back to the investors. You tripled your money in 10 years. That's not a bad return overall. And if you find a lot of deals like this where you could put down whatever amount, his analysts determine what's a good price, and you squeeze cash on cash profits over the next several years, you operate it lean, mean, online only operation. If you have several of them, maybe you share the same warehouse. Who knows which ways he could find a way to get this portfolio of companies to run and operate at bare bones pricing, so he can squeeze as much profit out of it before it's no longer salvageable. But that's how you do it. It's all about squeezing profit out of that company as it declines, as it dies. It's not really, their strategy was never really to turn these companies around and return them to their prior glory. It was to get them online only, running out of a warehouse, bare bones cost, and as profitable as possible, and return that profits to the investors. But that's clearly not what's happening here. They were a high-octane machine that grew very fast, said one brand licensing executive who met with the pair early during their rise. Before buying Tuesday morning, REV raised capital through a series of investor webinars over Zoom and emails seeking accredited investors, mid-sized whales with a net worth of over $1 million, excluding primary residents, blah, blah, blah. Last July, Mir sent clients an email with the come on. Me and Ty closed a huge deal to buy bodybuilding.com, a brand doing more than $100 million a year. Get on Tuesday's investor orientation call tomorrow if you want more details on our deals that pay up to 25% a year in monthly payments. 2 weeks later, Mir sent another email. Did you realize for every $300K invested, we send up to $60K a year? So I can't determine from these little clips, but if he's making claims that, they either paid out in the past or they will pay out in the future a certain set return that never happened or will never happen, then they could be on the hook for some kind of fraud. But that, they're going to have to figure that one out in the courts. And on September 12th, he sent out, want to get on REV's private deal flow? We already paid over $25 million to investors. Okay, so if that wasn't true, he could easily be on the hook for some fraud. All right, let's scroll down here. Meanwhile, a quick review of REV's collection of retail sites signaled trouble, industry sources note. The now bare bones Medell site looks like it hasn't been updated for months. And if you go to Medell's website, that is an understatement. It says 25% off latest gym apparel. Sale expires November 1st. And then if you actually click on the apparel, anything there, it just shows products were not found. It's effectively, it's bankrupt. It's not, you can't even buy anything off the website anymore. So Medell's is no longer operational. Blah, blah, blah. Other tabs promise licensing. A few available offerings include yada, yada, yada. This is crazy. The storied retail former CEO Mitch Modell fumed at the interview with the Post. They are not able to get regular merchandise and are selling stuff from 2001. It's all outdated. Okay, whatever. Modell claimed it had rebuffed by Lopez shortly after REV scooped up the famous Big Apple's mainstay brand for nearly $4 million in 2019. I was trying to protect my brand, but there was no interest on his part, Modell said. REV made headlines in December 2021 when it announced its plan to rebrand century-old Radio Shack into a cryptocurrency exchange platform. This week, there was no mention of crypto on the site. which still promotes Cyber Mondays and offers an eclectic mix of products under new arrivals, including guitars, ukuleles, and toasters. All right, whatever. Last June, Radio Shack drew scorn when its Twitter account began using profane language and drug references, an apparent publicity stunt to draw attention to the fizzled crypto venture. Pier 1's usually upscale glassware in China had been replaced by more low-rent offerings. It looks to me like they are buying exclusively from closed-out retailers like TJ Maxx and Marshalls and whatever is left when they don't have merchandise, when they don't want merchandise anymore. A distressed debt and brand licensing experts that did not want to be identified told the Post. They have an amalgamation of old, mediocre, or not relevant brands selling so many items that are sold out or not interesting. Their sales can't be very good. Well, from what they just said, sales declining year over year by 60%, and the ratio of sales to losses going up. That's an understatement. So like I mentioned before, with this investment strategy, I said it in a video, a while ago, more than a year ago, that this investment strategy is also, it's nicknamed cigar butt investing, where you take a used cigar that has, maybe a few puffs left on it. You pay virtually nothing for it, pennies on the dollar. You get your few puffs, you get your value out of it, and then you move on. You're not supposed to buy it, overpay for it, and then lose tens of millions more. I have no idea what the hell they're doing, but it would actually surprise me if they... I don't see any way that they don't declare bankruptcy before the end of the year. From these losses... This is actually the opposite of what should be going on. Or first of all, I can understand their sales declining because all their businesses are dying brands. But if your sales decline by 60%, you should still be squeezing out a profit. Out of 60 million in sales, they should be probably squeezing out, 20 million profit, something like that. But they're over here losing money hand over fist. They're donezo. And it looks like there's a lot of lawsuits coming down the pike, from what I've seen. That I'm going to put a couple up here. If they were making false claims about returns and guaranteeing investor returns and saying you're going to get this percentage, you put in 300,000, you're going to get 60,000 back every year and shit like that, then yeah, they could be on the hook for fraud. But I haven't seen enough data suggesting. A lot of times they could kind of cover their ass by putting, the fine print on there saying, hey, returns may vary. You need to be an accredited investor, meaning you need to be able to take on the risk and you could potentially lose your principal and all this stuff. Usually they have the fine print to cover them as long as they do not make any kind of guaranteed return claims. Or they say that they made a return previously that they didn't make. And the thing is, unless you can get someone on criminal charges, suing a company that's 200 million in fucking debt for what are you going to get out of them? They're about to declare bankruptcy and shut the doors. You're not going to get anything out of suing a company that doesn't have any money. So it looks like, probably before the end of the year, if I were to guess. Probably any day now, to be honest with you, with those kind of losses, their retail e-commerce ventures is going to go tits up and the investors are going to lose everything. And like I mentioned in the other video about this, I really don't feel bad for anybody here. These are accredited investors. All these people in theory are millionaires. So if Ty Lopez scams a bunch of millionaires out of 200 million, so be it. Sucks for them, but they should know better. All right, they should have done their due diligence. They should have watched my video. It would have saved them 200 mil. But anyway, I just thought this was funny. I needed to post this before it goes bankrupt and this information becomes outdated, because it could be any day now. Matter of fact, I need to upload this video ASAP before they file for bankruptcy. Anyway, thanks for watching, and I'll see you on the next video. Peace.